welcome in everybody. Shout out to everybody who is here already. Let me just get this thing going here. What's up, Trip? How you doing, man? How you been? We got the wrong. How do I change that again? This is power. What? Hey, thanks, man. Yeah, we're dressed up for the Roth review. Hold on, let me make a new one here. It's probably just gonna be the easiest thing. Second. Let's delete the display capture. Drop this down. There we go. Alright, cool. Now we're all set up. Thanks for the heads up. I meant to turn that on when I first started. Thank you. My bad. Haha. Appreciate the heads up on that. Bada boom, bada bing. Okay, cool. We got that situated. I don't want to go full screen because we're gonna have to look at fundamentals. So let me pull this up. So yeah, we're gonna be doing a quarterly review of the Roth now. We'll have another one. April is going to be... I was going to do it yesterday, but I wasn't really feeling good yesterday, so I didn't do it. Decided to do it today. But normally it'll be April 1st. And then there'll be one July. And then there'll be one in October. And then one again in January. And that's what we're gonna do, and we're just gonna be reviewing the Roth portfolio and cutting. We'll be cutting losses and taking gains and really kind of stress testing the portfolio. So let me pull up my parameters here to show you. This part here, I'll do that off screen or off stream because that'll be really boring. It'll be like working in Excel portfolio or Excel spreadsheet. But here, this is the one that matters for us. Broken thesis or bad fundamentals, we'll sell fully. If the position is too big, we'll trim it. We'll take either cut our losses there. If the fundamentals are still good and the stock just isn't performing, we'll cut some losses. We'll trim it up, and same goes for winners. We'll take some gains, and otherwise, and if that stock isn't doing good, but the sector is performing. Or an ETF for that sector is performing good, we will replace that stock with that sector ETF. So yeah, that's pretty much it. Oh, and that's not on there. 10% gain or 10% loss is kind of one thing we are trying to avoid. Which I know there are quite a few on there, but we have been seeing more of a bear market lately, so some of those we may hang on to, partially because they were very recently added. So hey, appreciate that, Trip, man. That's all good. Well, maybe you'll learn a little bit watching. So appreciate you hanging out, man. So first things first, I suppose we'll slide into here. And ooh, just noticed that. We gotta trim that window down. I'm glad I caught that. I'd rather have it this cut over here than anything. Nice, we're almost a half hour to market open. Let's trim this down a little bit now. There we go. Cool. Pull this up here. Just wanna, so let's trim this down. And suppose we can trim that up. Perfect. Cool. Just had to get that situated. Sorry about that. Thought I had that all done already, but I did not. All right, so I suppose we'll start with the winners. We'll take a look at Coke. Now, this is Coca-Cola Consolidated. This is the bottling portion. This isn't the drink making portion of the company. This is just the bottling. Which I didn't know that until I bought this, or until I was looking into this. But yeah, as you can see, it's performed good. We'll right-click the source. You can fill the screen if you right. Oh, really? Oops. Yeah, whatever. I think we're... Transform. Let's take a look. Center on screen. There we go. Ooh. Let's try that again. Cause that left some a little bit cut off at the end there. Fit to screen. There it is. There we go. Heck yeah. Nice. Thanks, Trip. Cool. Okay. So, wow, look at that. These are monthly candles, by the way. So each candle here is a month time frame. So, just want to make sure that is known. Let's take a look at the fundamentals. I think we will trim some of this. Not a lot. But we are a little far away from that 200-day moving average, which always usually brings a pullback of some sort. So you might as well take some profits while it's high. PE ratio 33, which is a little high. Let's do financials. Wow, not that surprising, but March, this last quarter, they lost revenue. Revenue is down. Actually down for all 4 quarters. operating income went way down. Wow, that's crazy. Let's take a look further. Net income. Wow, I had a spike in that quarter, but down overall for the year. Makes sense. Sell a lot less in the spring than they do in the winter. Yes. Yeah, I think historically, like, December is one of the best months in the stock market. I could be wrong, but I believe so. Profit margin decreased. Wow, that's weird. It doesn't show the earnings per share. Where's operating expense? Wow, way over the income. So yeah, I think we'll trim some of this position here. Probably about half of it. I have, well, maybe not half. We'll sell one share. We'll do market. So when the market opens in a half hour, it'll sell. Most likely, given the massive consumer holidays, yes, that is exactly why. 100% why. Lots of buying. We gotta get our Thanksgiving turkey. We gotta get our Halloween candy and costumes, and then it's Christmas, man. Then we need to buy everybody gifts, man, for Christmas. You know, the holiday cheer, you know. And then this is ExxonMobil. This one has been in the portfolio for over a year. As you can see, it's been doing pretty good. When was this? January? Yes. After January, it's just been on a tear. So, and I think today will be a good day for them. And given the situation in the Middle East, as long as oil prices continue going up, I don't really see a reason to trim this. But let's take a look at the fundamentals. Financials, revenue increased. Actually, no, decreased. But I mean, right on track. Let's continue. Nice little spike. Yes. Absolutely. Exxon. That was, that one, this, I believe, when was the whole Venezuela attack again? I believe that's what caused this gap here. Right around that time. Or it was this candle. The February candle. I can't remember. When was that? February? But yeah, that was a big, few months ago. Yes. But that was definitely a major contributor to that upswing. Net income increased. That's good. Profit margin decreased a little bit. Earnings per share increased. Well, increased from last quarter, down from, I mean, fluctuated, ebbs and flows. Wasn't increased from beginning of the year. Where is the... wait, no, that's not it. Did I pass it already? Oh, I did. So, operating expense, operating income. I don't like that. Total operating expenses. But I guess we'll see where that one goes. It is a winner. And I think oil prices are going to continue to go up. So we're going to hold that one for further review till next quarter. And now Johnson & Johnson. Jeez. Look at that. That's unreal. That's a great pump since like COVID. Oh, they didn't really do very well for COVID. Oh yeah, right here. And then everybody dipped down after COVID. Oh yeah, yeah, man. Oh, that Strait of Hormuz, man, controls like 20% of the global oil supply. Well, and a lot of that oil goes to China and Russia. If dude, it affects us, even if we aren't, you know, getting that oil. Everything's gonna cost more. Oh yeah. Yep. Had them giving the products out. So getting a little far away from this 200-day moving or 20-day moving average. This is the 200 down here. But let's take a look at the fundamentals, of course. When you invest long term, like a lot of traders, they'll ignore fundamentals. That's trading. Like long term investing is different. You need to have a long term. You need to have the fundamentals. Some traders will say, "Oh, fundamentals only come out a quarter. This comes out every day." And it's like, yeah, but kind of need to look under the hood if you want to think about 10 years from now. You know, if you're going to buy and hold Warren Buffett style for 10, you know, Warren Buffett, our goal is to never sell. You know, you have to look at the fundamentals. Got to know what's under the hood. We assume total expense during COVID were massive for J&J. Oh, yeah. Yeah, you know it. We won't be going back that far. We could. Let's take a look at the cash flow. Well, no, let's just start with we skipped over those for the last one. That's okay. We'll look at the balance sheet and the cash flow for the rest of them. That's kind of really more important when we get to the losers. So revenue decreased this quarter. Decrease from the beginning of the year too. Operating expenses decreased. Revenue or income. Let's go to. It doesn't have it. Operating income is increased. Net income 11 billion. Wow, that's crazy. Crazy increase. Did they come up with a weight loss drug? I'm not sure. That seems to be the the ticket for the drug companies these days. Balance sheet. Let's take a look at cash equivalents. Wow, that's good to see. Cash and equivalents increase. Let's take a look. I want to see the cash. Where's... Oh, wait. The cash flow's up there. Return on assets. Looks pretty decent. Okay. Let's go to cash flow. You had that net income increase is freaking crazy. Net change in free cash flow. That's the one we want to look for. Ooh, free cash flow decreased. Not necessarily a bad thing for a company that large. They have investments and all kinds of other things. But okay, so that's Johnson and Johnson. You know, what's the dividend? Pretty decent dividend. We're gonna hold. We're gonna hold till next quarter. We'll see where it's at next quarter. Well, now next one's Caterpillar. This one on an absolute tear last year. No, this year really. But last year too. Where was it? January 23. Yeah, this was it. Right here. Oh, okay. Gastric bypasses. Okay. Interesting. What was it? Kind of. Let's take a look. Oops. Let's just do the AI overview. Unique design. Oh, what? No shit. Robotic surgical system. Latest development. Gastric bypass technology. FDA submission. January 22nd. MedTech file. Marketing authorization. After successful clinical trials. That's why it skyrocketed. That's crazy. The future is now. The future is now. That's cool. Very neat. Okay, I think I mainly got into them because they pay a decent dividend. That was one of the main reasons I got into them. Also, too, they're kind of a, an essential, one of those essential companies, like healthcare is kind of like, it's one of those sectors that's just like never gonna go away. But let's move on to Caterpillar. They have been on an absolute tear. This oil price increase, though, will hurt them long term. That'll stop growth. That'll slow growth down. They need growth. They need development to continue. So, and if oil prices stay high for a long time, that's going to slow growth down. So, let's take a look at the fundamentals quick. Okay. Revenue decreased. It's maybe a time to cut it. But we need to hold that on reserve. Net income decreased. Balance sheet. Long-term debt's getting smaller. That's good. They're paying think they're dead off. That return on equity is nice. Although it's decreased a little bit. Let's look at cash flow. Cash from operations, wow, has significantly decreased. Wow. That's a significant decrease. And with how oil prices are right now, I think we're to sell. And I believe I have only $1 a day DCA on this. So we're going to keep that open and just keep our eye on it. Okay. 14 minutes till market open. All right, now, Walmart, everybody's favorite. Yes, I agree. A lot of that depends on the oil, man. If that, we got to get that thing situated, man. Because that will slow growth if it'll drive the cost of everything up. And thus, it's going to cost more to build, which will slow growth. So we'll see. That's why I am going to keep it on what you said is the reason why I'm going to keep the daily DCA. Just keep an eye on it. We're going to be reviewing this every quarter, so it's just one of those things. Walmart been on an absolute tear for the past 2 years. I mean, kind of forever. Since here. 10 years. Dude, if you own Walmart stock, look at that. That's crazy, too. A bounce right off that 200-day moving average. And it's just never came close to it since. Yeah, I guess so, man. They've been doing a lot of business with their online market, or their online stores, I guess. They've kind of stepped up their game in that department. So that's just nuts. High PE though. Let's take a look at the fundamentals, of course, and their personalized pricing. When did they start that? Wait, they do price matching now? Is that what you mean? Do. Earnings. Guidance remains cautious. Revenue decreased. It's not that surprising, though. It's only online, but no personalized price is cost based on your actual demographic. Whoa. In other words, you may pay more than Joe Schmo, who makes more money than Joe Low. Oh, really? That's crazy. Whoa. I didn't even know like that was possible. How the hell do they do that? Is it based on like area? Like geographical location? Like how do they do that? Operating expenses have decreased. Net income was actually increased from that quarter. It came down. So I don't know. Were these just higher than usual? Let's take a look at the cash flow. Oh, balance sheet. Do. Total current assets. It's decreased a little. Where's the debt? Debt. Return on equity is decent. Long-term debt. Here it is. Long-term debt is increased. Don't really like that. No insurance. The ins and outs. Amazon does. Oh shit! Really? Data mining? Oh yeah, that makes sense. That makes sense. Of course, I forgot about the data, man. They know more about you and me than we know about ourselves. Net income decreased. Oh no, that's kind of cash flow from operations decreased. I think we're gonna hang on to Walmart for another quarter. We'll see where the market goes. VLO, this one was added fairly recently. It's about 106 days ago. No, I don't know that actually. Probably less than that. But about around 100 days. AI says using your data, app usage, purchase history to show you different price than the person next to you. Yes, VLO. So this spike here was directly caused, February, by the Venezuela. So VLO, they refine crude oil. They're one of the only companies that actually refines like heavy crude oil, and that's what Venezuela has. So they spiked big time when we went over there and did all of that. That was actually around the time that I added it. So just out of curiosity, I'm going to take a look. We're going to hang on to that probably regardless, unless we see something totally egregious in the fundamentals here. But yeah, we'll probably hang on to that. Hey, what happened to the tunage, man? There we go. Okay, VLO earnings. Financials, actually. Revenue, pretty consistent. Operating expenses has oh wow, significantly decreased from this quarter. December 25. But operating income is also significantly decreased. Let's take a look at the balance sheet. I didn't know that they have gas stations as well. Yes, they do. Not too many of them down here in Florida, but yes. Short-term cash investments, long-term investments kind of stayed the same. Long-term debt slightly increased over the year. Let's take a look at cash flow. Cash flow has decreased from operations. It's usually not good. Free cash flow, here we go. Increase from last quarter. Decrease from September. An increase from December. Alright. Interesting to look at. Like I said, that one has not been in the portfolio all that long. So, kind of odd topic. Recently moved, now back in a state with Wawa. Nice, man. Got one down the street. Nice, man. Where'd you move to? Alright, this is an ETF. It's a Vanguard Developed Markets ETF. So this is, you know, in markets like United States, more developed markets. Indiana, holy cow. They have Wawa in Indiana? Didn't know that. Nice, dude. You like it? Did you guys get hit by that huge snowstorm like last month? Did you guys, I know Wisconsin got hit bad. So VA, this is an ETF, so there's not really earnings reports, but we can take a look at implied volatility, stuff like that. Oh, and hey, we could do the AI overview quick on it, just for gigs and laughs. Compelling relative international developed markets currently offer attractive valuations. Resilient long-term growth. Major regional exposures such as Japan, benefiting from governance reform, structural market rallies. Let's take a look at some of the bearish. Got like 2 feet of snow. Oh wow, really? So down there, you guys even got a bunch of snow. Yeah, dude, they got like I think my hometown, I think, got 27 in like less than 2 days. Some parts of Wisconsin got more, like the northern parts got dumped on. Technical weakness and sell signals have recently shifted to negative outlook, with some analysts downgrading the ETF to a sell candidate. Really, price is now currently below its 200-day moving average, possibly indicating loss of momentum. It's definitely not under the 200-day moving average on the monthly candle. So let's bump it down a little. Let's go to the daily. Yeah, it got close to it. Oh no. Hard to say. Oh, market's open. Bada bing, bada boom. Look at that. Look at that candle open, man. Wow. Bam. We just watched that in real time. That's crazy. I think we should take profits on this. And I will leave that DCA open. Let me double check. Wrong one. Let me double check that. Because that may not be, that may be more than a daily DCA, or a $1 a day. It's a lot easier to do it on this one. Let me just double check. Yeah, 250. I'm gonna bump that down to $1. And we'll review that at a later date. Next quarter. Oh, what's happening here? Edit, please. There we go. We'll bump that down to $1 a day. I like doing daily because it tends to, I mean, when before this downtrend, we were up 16%, almost 17%. And so that has seemed to break up a lot of like market noise, doing the daily, small amount daily. I've really have liked that performance. So, oh, whoa. Hey, Bennett. What's going on here? Buying power. That was coming out of my checking account? What? That's funny. Okay, so now we got that situated. Looks like it's not falling off. People are buying today, and we must be having a more green day this morning. Let's take a look. Just out of curiosity. Let's take a look. S&P's down. Yeah. That's what I kind of expected. The futures were down after Trump's speech yesterday. I think the market kind of was pricing in and expected, you know, Trump announcing that we weren't, we were backing out or whatever, that we were done. And I didn't watch it, but I heard what was said, and that is not what he said. So the futures instantly just... And now we are seeing the... wow, the NASDAQ is up? No, that's down. People are buying it up, though. Unless that's glitching and that's supposed to be a red candle. But no, that's, no, we just were open down here. Or no, we opened here. Initial sell-off, and then, wow, that's a, oh, that's a 1 week fucking candle. That's not a daily. This is a daily candle. That's what, that's, that's funny. All right, back to the Roth review. Let's get back on track. Otherwise, this stream's gonna take all fucking day. Positions. So yeah, that was VEA. Oh, yes. Okay, now CVX. Chevron, they're going down. I'll blame it on the ADHD. Yes, I do have a dose of that, for sure. That or ADD, one of the two. So, the monthly looks pretty decent. This is a new monthly candle. Bit of a hammer forming there. I mean, it's just started. We're only on day 2 of the month, but so Chevron, they pay a very good dividend. What is it? Where is it? Oh, it's in here. Almost 4% dividend. Excuse me. So, but these guys were one of the companies that were already had refineries in Venezuela when that all happened. So that's what contributed to that. And as you can see, I kind of, got in it, went around that time. So we're just going to leave this one sit. Out of curiosity, we'll take a look at the fundamentals. But we're going to leave that one sit. Oil prices dropping. Probably won't be good for that one when they do eventually. But I think long term, that's a good bet. Revenue increase this quarter. Let's go to balance sheet. Total assets kind of decreased than from earlier in the year. Total liabilities has decreased. Go to cash flow. Hold on, we gotta go back to income statement. Where's here we go. We forgot to look at the expense and income. Looks like it's going up. The Chevron. That's what I'm thinking. Wow, where is it? I always lose my fucking spot on these. Operating expense has decreased. And then income has increased on average. So that's good. Good to see, good to see. Now next one. NEE. Oops. I should have added this one a long time ago. This one was in my regular broker account for a while. And I ended up selling it early. I think it was around, yeah, it would have been around here. I was buying it up around here and I rode this wave up, and then when it came back, I sold it. But then, man, as you see, if I was just patient, I would have, I missed out on a lot of gains. And one of the many things that caused me to start thinking on a more long-term perspective with this stuff. So, what initially got me into them is that they're a partner with FP&L. They provide Florida with a lot of their power. And they have their solar company. They have solar fields. But they have now, recently, this past year, started branching out into the natural gas aspect of things, and that has contributed to this whole run this last year. Yes, sometimes it does happen that way. Sometimes you gotta learn lessons the hard way. It just is what it is. Some people call that the tuition of the markets. So NEE, it was looking promising. Let's go to the fundamentals. Not near. Looks like they're up today. Financials. Operating expenses have decreased. That's good. And then the operating income, I would say, has increased on average, so that's good. Net revenue has kind of decreased, but let's take a deeper look. Where's the debt? Debt. Long-term debt has decreased by a good amount. Let's take a look at the cash flow. Yeah, I'll say it again. I've said that my whole life. Many lessons learned the hard way. Free cash flow. Ooh, free cash flow is negative and seems to be increasing. Hopefully that is just because they are a growing company. So we'll take a look at that. We're we're still up. 859. We'll take a look at where we stand next quarter. Now Hershey's. Everybody loves chocolate, right? This seems to be in a massive downtrend. It tried to break out. Hard to say if that's a double top on the monthly. I mean, I really don't like this candle, and then the gap down today. They pay a decent dividend. I'm thinking of cutting my losses and moving on. Contamination scandal? Fucking dumbass. Oops, forgot to put the A. Oh yeah, that's right. Forgot about that Florida University study. How did I forget about that? Where they're fucking finding arsenic in candy and shit. I think we're gonna close that position. I think we'll stop that DCA. Mars got hit with it too. A lot of them did. It was like almost every major candy manufacturer. Oh, I don't need to do that actually. I can just go here. And investment. That's gonna continue down. I wouldn't be surprised. It may be a buy around that 200-day moving average. A lot of you see, I mean, look, it's even happened on this one. A bounce off that 200-day moving average. I could probably pick any stock here, and we'll see one. Bounce off the 200-day moving average. Well, that one doesn't have a 200-day moving average on the monthly. Well, that one's always been far away from it. Okay, well, this is the next one that we need to do. So this is the Vanguard Small Cap ETF. Plus with Easter over, next holiday spike isn't, yeah, man, Halloween, baby. It's gonna be a while. This is small cap ETF, so this is you know, small market cap companies. So this tends to get hit bad if like the broader market gets hit. Let's just take a look at what the AI has to say. Market sentiment remains long-term bullish. Some AI-driven projections suggesting 18 to 25%. 12%. Recommend ETFs? Yes. I think they're a good way to, you know, if you want to get into a sector. It's a good way to like not pick, you know, because stock picking can, you know, limit yourself, or sometimes some stocks have a bad year, or you know, relative to the sector don't perform well. So they're, in some sense, they are good to get into like a certain sector or whatever, honestly, because stock picking sometimes isn't right for everybody, you know. Like sometimes you can just go into the sector and perform a lot better. And I've learned that myself with countless sectors. You know, so we're still in the winners here. You'll see. We'll be cutting some in a minute here. This portfolio is kind of, my dad sends me some stuff sometimes and I'll throw it in on $1, you know, just because $1 a day isn't gonna break it. And we can we review it quarterly, so we can take a look at, you know, it's actively managed. So that's kind of why I do that. So right now we've kind of accumulated a hefty number of stocks in this portfolio. Low cost structural advantage, Vanguard. Yeah. They have low expense ratios. Technical momentum shift. 10-day moving average cross below its 50-day moving average. Yeah, that's never good. It doesn't say on what chart it did that, though. I don't like that. One day? Did it do it on the one day? No. Didn't do it on the daily. Was that on the hourly? Yeah. So it is a downtrend in the hourly. But that's hourly candle. We don't base our long-term decisions off of an hourly chart. Yeah, man, gotta be careful with the trading. Gotta be careful. The day trading thing, you know, it can be fun, and you know, but historically most people lose money. I've lost money doing it, you know. So I've kind of took a step back and was like, what account is performing better? The individual account or my Roth? The one that I don't fuck with as much. My Roth outperformed it by a long shot. I've had some success back in 2020, but not much. It's just it can be so hit or miss, man. Like, you make $1,000 a day and then lose that all the next day. You know, so it's just kind of one of those things, man. It's kind of gambling, though, day trading, in my opinion. Like, unless like you're a crazy fucking like whiz technical analyst, which I am not. So yeah, I think it's gambling for the most part. You know, some people know what they're doing, and some people do have a lot of success at it. But I learned that it's not for me. The long term has worked out a lot better for me. trend experienced significant over the past month, underperforming the broader blend category, which returned approximately 7% year to date. This recent weakness has pushed the fund toward a hold or accumulate rating rather than a buy for some analysts. Ongoing inflation risks causes Federal Reserve, which may deliver on a single rate cut 2026, pose headwinds for small cap stocks. Persistent core inflation and high borrowing costs continue to put pressure on small companies with higher sensitivity to interest rates. That's where I'll start once I get some more cash flow and expendable income, is to do long term. Yeah, man, like there's a reason why like companies have 401ks for like their employees and stuff, you know, because over a long time frame it seems to work, you know. That's a very rudimentary like way to say it, but so that's the Vanguard small cap. Yeah, the interest rates isn't the best for it, but and it seems to be in a bit of a correction phase. I'd be interested to see what it does here, if it forms like a head and shoulders and then dump. But this is the weekly. Let's take a look at the monthly. So, and that looks a lot less bad. It's had 2 bad months. So, we're gonna hold on to that one. Man, this whole war thing, it's really like put so much pressure on the market. You know, and the fact that we don't know how long it's gonna last, like, is a huge unknown. The markets don't like that shit. How long has Trump been saying that the operations are nearly concluded? He's been saying that shit like for 3 weeks. So it's like, are they really? Are they really that close to being done? I don't know. I don't know. I definitely don't know. So you just kind of got to play it by ear, man. One of those things. So we got another ETF, the S&P 500 Momentum ETF. Tracks components with the strongest volatility adjusted momentum. So a bit of a pullback again, you know, but that's a bit of indecision here and then, sell off. Let's just take a look at what the AI has to say. What was the ticker again? SPMO. SPMO. The S&P 500, not what, so S&P 500, that's gonna be a combined of many sectors. That's just the top 500 companies in the United States, which I believe it's based on GDP, or not GDP, yeah, like their net profit. It's an index. Let me make sure. Let me double check that. Free float market capitalization, largest liquidity traded company. Yeah. Market. Oh yeah, market cap. Wait. Companies must have high liquidity, market cap over specific threshold. Yada yada yada. Yeah, they're just like the top performing companies and top 500 performing companies in the U.S. market. But this one's different. This weighs it different. This is a little different than the S&P 500. This ETF. This one's more based on volatility. Oh. Oh, yeah. So, declined roughly over the past month. Aggressive earnings growth forecasts demonstrate top-tier next year EPS growth estimates 26%. So those are, I don't like that. That shit, cause it's just estimates. You know, it's predictions, speculation. Like, they could totally miss that due to, you know, other factors in the market. You know, oil price going up is one. So it's not like Vanguard ETF. I believe Vanguard does have one of these, a momentum ETF. I believe Vanguard does have one. Vanguard, they usually have, they're known for having cheaper expense ratios. So they may be a good ones for you to start with. Because you're paying like less for them to act, you know, because they charge you a fee for them to manage the fund, or the index, really, is what it is. So they charge you, like this one, they charge 0.13%. Resilience and AI leaders despite broader market volatility in early 2026. Top momentum holdings like Nvidia, Broadcom, and Meta remain resilient. These companies are delivering 13 to 15% earnings growth, providing a necessary buffer in an environment characterized by sticky inflation and shifting global growth sectors. Risk of PE, now this is bearish. Risk of PE compression, multiple compression. Market analysts warn that the 119 four-year compounded EPS growth rate implied by current holdings may be unrealistic. If actual earnings growth is more modest, the fund's high forward PE is of approximately 20.10x could face significant contraction, erasing gains even if earnings remain positive. Like I said, I'm so... oh, yeah, man. Yeah, no worries, man. It's all good. It's all good. We all started somewhere, man. High sector concentration risks. Following in the March rebalance, the fund is heavily weighted in technology. But that makes sense, because it's the most volatile market. And industries, 15%. This lack of diversification in ETF makes the ETF vulnerable to sector-specific downturns, such as the 26% contraction seen in tech during 2022, which cannot be adjusted until the next rebalance in September. Now this one is the most important one, really, in my opinion. Geopolitical and macroeconomic headwinds, ongoing international conflicts, and rising energy prices have dampened expectations for synchronized global expansion in 2026. Fear of a recession later in the year has prompted institutional investors to rotate into low volatility and dividend-focused sectors, leading to recent momentum underperformance. So, if this conflict is short-lived, this is a good buying opportunity. I believe this is another small DCA. We're up right now. I see no reason to really sell it. So, we're gonna leave that one. This is a very new one. As you can see, this is another $1 a day. Tyson Foods. We'll look at the fundamentals very briefly. As you can see, I only added it, about 23 days ago. 22, 20 some days ago. God, could you imagine buying Tyson Foods back in 2012? That'd be nice. That'd be a nice buy back then. There's a good example of that 200 moving average bounce. Boom, boom. Looks like the price couldn't break above that resistance, that old support level. Now resistance. It did break out above it, but now it's settling down. You have a potential 10-day moving average cross soon. That would be good for it on the technical aspect. Let's take a look. At the fundies. Slight revenue decrease. The operating income. Whoa, what happened there? Operating income has increased. And the operating expenses, total operating expenses, has decreased. So that looks good. We like seeing that. So even if that one wasn't, it would have to be like really egregious for me to say, oh wow, what did I get into, and cut it. So just because it has not been in the portfolio for really hardly any time. So all right, this one here, this one has been in the portfolio for a long time. Oh, Realty Income. This is a REIT. If you don't know what a REIT is, they are a real estate company. REITs, they operate in real estate. They're a way for investors to get into real estate without buying a house or buying a business or buying a rental property. You can buy these, shares of the companies, and they buy the properties and operate the properties. And there's all kinds of different ones. There's ones for self-storage. It's kind of crazy. This one, I believe is in single-family homes. And I believe there are earnings reports on REITs. So, Realty Income Corp. Financials. Slight revenue decrease. The operating expenses have decreased. And the operating income has, it's kind of mixed. Slightly decreased. But I don't like that the operating income is lower. Don't really ever like that for a long-term. EPS has dropped from the beginning of the year, but has increased from last quarter. Net income has decreased to increase less from last quarter. Major decrease from early in the year last quarter. Maybe bouncing back. So, but that's O. I think we're gonna hold that. We're not gonna change there. They pay a nice dividend. Over 5% dividend. So we're just gonna hold on to that one. Qual. The USA Quality Factor ETF. They track index of large U.S. large cap and mid cap stocks selected and weighed by high ROE, return on stable earnings growth, and low debt / equity relative to peers in each sector. I like this one. This one. Oop. Word. Excuse me. Excuse me. So, this one added fairly recently. Hasn't been in there for a year. We'll go to qual. We'll hit the AI review for qual. Declined over the past month. Macroeconomic uncertainty and recent volatility in high valuation tech holdings drove this correction. Analysts project a recovery with an average 2026 price target range approximately for $206, reported by Resilient Corporation. Corporate fundamentals and potential interest rate cuts. Strong analyst price. Market consensus remains optimistic for 2026, with analysts setting an average target of approximately, oh, I just said that. Fight to quality factor, ongoing market volatility, and rising input costs from tariffs are expected to drive investors toward quality stocks with low debt and stable earnings. This environment typically favors the ETF strategy of weighing companies with high return on equity and resilient financial structures. We'll take a look at the bearish, what the bears say. Short-term technical weakness, recent price action is shown technical divergence with falling volume on higher prices, signaling potential further declines. Heavy tech and AI correction, with over 33% of the portfolio allocated to information technology. The ETF is highly sensitive to rapid AI-related capital expenditure. Significant institutional outflows. The fund has experienced substantial net outflows, including over 620 million in past month, approximately 8 million over the last year. This trend suggests a shift in institutional sentiment despite the ETF Silver Morningstar rating. That's interesting. All right, buddy, I'm gonna have to head out to work. I'm gonna keep you lurked up. Hey, thanks for the lurk trip. Thanks for hanging out. Much appreciated, man. And yeah, man, thanks for hanging out, man. It's always good having you here. It's been a minute. It's good to talk to you, man. Hope you have a good day at work, man. Freaking grind it out. We're slow right now. We're in between jobs, so my boss said it's balls to the walls starting next week, so should be fun. We'll be out there painting. All right, man, have a good one. Thanks for hanging out. So that's the quality factor. We're gonna leave that one. That one hasn't been in the portfolio for long. Symbiotic now. Wow, we're actually up. That's crazy. This one has been down for a while. Symbiotic is a robotics company. They have a partnership with Walmart. They do robotics, like warehouse robotics. So they're making warehouses to be, fully automated, or mostly automated. As you can see, they've seen a bit of a correction here in the past, couple months. Seems like some buyers have been stepping up. Let's take a look at the fundamentals. looks like they've been beating EPS consistently. And revenue has increased pretty significantly consistently. Let's get into... So revenue, slight decrease in revenue this year. Operating expenses, slight increase. It's okay, they're a growing, small growing company. Oh, total operating expenses has actually decreased. So that's good. Net income decreased. It's at the balance sheet. Oh, excuse me. $85 long-term investments have decreased. Let's take a look at the cash flow. Cash flow. Free cash flow. Free cash flow has kind of been all over the place. But I'd like to see it on the high end this quarter. You know, we're not seeing consistent decrease in cash flow, so that is good. Where you will leave Symbiotic, as you can see, new add to the portfolio. Another very new add to the portfolio, the Granite Shares Bloomberg Commodity Broad Strategy ETF. This is just a commodity ETF. We'll pull up the AI overview. So, climbed 10% last month, strong year-to-date, monthly outperformance, geopolitical, and inflation hedge. That's why I have it. Strategic portfolio rotation. Bearish. Moderating global price forecasts. World Bank projects to decline in global commodity prices by approximately 7% in 2026. Agricultural supply uncertainty. While some agricultural sectors have seen price spikes due to drought, there's a growing disconnect between the reported data and physical market signals. Favorable supply conditions in some regions and higher fertilizer costs are forcing market participants to reassess the sustainability of recent grain price gains. Volatility from geopolitical shifts. Recent price action shows significant volatility linked to shifting military signals. For instance, crude oil prices fell over 4% in early April following optimism regarding potential ceasefires. Yeah, I don't think that's going to happen. We'll see, though. Rapidly changing geopolitical narratives pose a risk of sudden price reversals for the fund's heavily weighted energy components. That's okay. It's a very, very new add to the portfolio, as you can see. GLD. On the 1 month chart, bullish or bearish engulfing candle there. I don't like that. Let's go do the AI overview quick. We may sell that. I feel just on a first that gold is overbought. I wouldn't be surprised if this continues to go down a little. Aggressive central bank accumulation. Global central banks, particularly from adversarial nations, are diversifying away from the US dollar To hedge against geopolitical risk and potential asset freezes, approximately 95% of central banks expect to increase. I lost my spot. Except to increase gold reserves through 2026, providing a price-insensitive floor for the metal's valuation. Support long-term price despite recent volatility. Major institutions like JP Morgan and Goldman Sachs maintain bullish. Favorable macroeconomical shifts, dovish signals from the Federal Reserve, and cooling inflation hopes may lead to lower real interest rates. Historically, following real yields reduce the opportunity cost of holding non-yielding assets, potentially triggering a significant near-term rebound for the ETF as liquidity dynamics shift. Strengthening U.S. dollar and rising 10-year Treasury yields, recently climbing approximately 4.38%, create significant headwinds. When real yield rise, the opportunity cost of holding gold increases, making it less attractive to investors compared to interest-bearing assets. Premium exhaustion. The market is showing signs of premium exhaustion where gold fails to act as a safe haven during active conflict escalation. Paradoxically, prices have retreated despite Middle East tensions, suggesting that much of geopolitical pressure value already priced in during 2025 rally. Technical patterns identify a dead cat bounce pattern, warning recent price gains lack volume necessarily for a substantial breakout. The ETF holds 4,000 support level could trigger further liquidation to 38 bear case scenario. Yeah, gold, man, that increase is crazy. Let's take a look at the weekly. What's this doing on the weekly? So I had a bad week. Oops. Had a bad couple weeks. I think this is going to be a hold. We'll continue that one. Another fairly recent ad. Kind of a inflation hedge. On second thought, you know, I'm gonna step away for a second. It's been an hour and 30 minutes. Let me stretch my legs quick, and I'll be right back. Sorry about that. I just needed to stretch my legs. Oh, fuck. I forgot my fucking drink. 1 second. Oh, yeah, all right. Oh, I just spilled it all fucking over me, dude. Dang, man, I spilled it all over my pants. Oh, wow. All right. We'll ride it out. We'll ride it out just for you. Just for you guys. We're going to ride it out. Just for you guys, we're going to ride out the wet pants. It's all up on... It's like I pissed my pants. Like it's all up on my groin. All up on my junk. So, this one, waste management. Did this one kind of an inflation hedge. Our garbage is not going away. So that's kind of the thought there for that one, you know, very briefly. It looks like it's doing good, man. You know, we're on the 1 week. Let's go to the monthly, long-term mindset. Did good past couple days. A little bit of a sell-off. I like that it stayed within this candle's range. You know, this, I truly believe our our garbage ain't going anywhere. Like, that's going to be a necessity. Always. It's always going to be a thing. We're always going to need our garbage to be taken and done something with, you know, whatever they do with it, you know, they'll put in the landfill, burn it, whatever they do, we're going to need that. And they pay a decent dividend, you know, nothing crazy, but 1%, 48. I think they're a dividend aristocrat or something of that line. You know, like I believe that they have, you know, I don't think they're a king. I think they're an aristocrat. But we'll do WM, waste management. Earnings, financials. I always hit earnings. Oh, excuse me. Well, we'll just compare these quick. ETFs. Oh wait, no, that's Caterpillar. Previous reports. Decrease. Minor decrease. Increase. They've been decreasing a little. Revenue decrease. Balance sheet. Let's actually go to there. So the expenses higher than the income. Don't really like seeing that. But again, this is a very new recent holding. You know, that we just started. You know, $69 in it. Daily DCA. $1 a day to break up market noise. Let's look at debt, long-term debt. Looks like it's pretty consistent. Scroll down, free cash flow. Here we go. Ooh, major decrease from all of the year. Major increase though, and then I don't see anywhere on here like did that go to debt at all, or their debt? they could have paid it something like that. With that, okay. So content may include mistakes. Another recent holding. So when Ron DeSantis, this was a while ago. When Ron DeSantis announced the Florida vertical takeoff taxi from Orlando to Tampa, I believe is where it's going to be. I looked up the companies involved with the building of the actual vertiports, the companies that are going to be providing the actual aircrafts, and Embraer was one of those companies. We made a pretty good amount of money on that stock. We accumulated a pretty decent amount of shares, and we sold that before their earnings report, which, I mean, was an absolute awesome move. We made some decent money on that trade. And that was a great move because they sold off big time. And I added them to the Roth a little bit after that. After, like, the initial, like, sell-off after the, and it's continued to go down since then. But as you can see, it's only $22 here. It's $1 a day. So we'll just hang on to it. We'll take a look at their earnings. But that has not been in the portfolio very long. Let's go to the 1 year. Let's go to the daily. They had a decent year. Here's was the peak. They hit $80. Now, are we gonna get a bounce off that 200-day moving average? Maybe. So, right now is good. If that's the case, right now would be a good time to accumulate. And that's why we have the daily DCA, and that's why we check, why we review the Roth quarterly. That's just how we do it. And we are going to be streaming those now. These weekly, or not weekly, quarterly Roth reviews, we're going to stream. Give you a little, I'll try to do other streams, but that's what I'm going to commit to. I would really like to do one a week, but with this house, I bought a house, and there's just so much to do. That's consumed all of my time. So, and today I, kind of wanted to take it easy. I've been going hard again. And, kind of just wanted to take it easy today. Review the Roth. I was supposed to do it yesterday, but I wasn't feeling good. Alright, so, yeah, shout out to everybody here on the live. We will, so this is the, IVV. This is the true, S&P 500 ETF. This isn't the quality factor. This isn't the momentum. This is the S&P 500, It did, I kind of wish I just owned this last year. Instead of 16% out, I think I would have gotten, what was it, 19, almost 19%. So we're just gonna hold that. We'll take a look. There's nothing to look at as far as fundamentals. They have a good expense ratio. There's not much to say there. It's the S&P 500. I do have this a little bit larger than $1 a day. Now I've kind of weighted those. Most of the ETFs are more than $1 a day. we'll move on now. Finally, we're into the losers. So, this one, as you can see, added recently, so we won't mess with it. But this is Vanguard Total International Stock ETF. These are international companies, so obviously the Middle East conflict is putting a big damper on it. Long term, though, I think this is a really good bet. You know, unless a major global escalation were to happen, I believe long term this is a good bet. You know, this is emerging markets essentially. So yeah, I don't know, not much to say there. We could do the AI overview, but I think it's just yeah, why not? What was that? Texas. Attractive relative valuation. International equities continue to trade at significant discounts. Yada yada. Global growth resilience. Market consensus forecast. Equities to return roughly 11% over the next year, supported by resilient economic expansion and continued AI investment. And analysts expect these structural tailwinds, alongside potential modest easing from the Federal Reserve, to support broadening bull markets across developed and emerging regions. Consistent dividend income. Fund maintains attractive dividend yield of, you know, what the current thing. Rising tensions in the Middle East and broad-based energy stocks have led to elevated inflation projections create a stagflationary headwind that could dampen international equity returns and increase market volatility. Currency and dollar strength. As an unhedged fund, its returns are highly sensitive to U.S. dollar strength. Recent stabilization of the dollar following shifts in Federal Reserve leadership sentiment threatens the dollar debasement trade that previously boosted international returns, potentially shrinking gains for U.S.-based investors. Technical momentum weakness. The fund recently dipped below its 50-day moving average, signaling a short-term trend shift from upward to downward. Technical indicators like the MACD, the momentum sector indicator, yada yada. Don't care about that. Long term, we look pretty good. I mean, maybe this is the beginning of a major dump. That's why we check it quarterly. Alright, now another emerging markets fund. Another one that has not been in the portfolio for a long time. This one, I believe, pretty heavily weighed in China. There's a lot of Chinese companies in this one. I'm not really actually, I don't think I'm going to talk about this one much. I don't think there's a lot of reason to talk about the ETFs that haven't been in the portfolio a whole lot. So, here's another one. Hong Kong ETF, kind of self-explanatory. I believe China is a big emerging market. Long term, this is thinking very long term. U.S. debt doesn't look good. And I believe, potentially, that China may possibly be the next reserve currency. Read this book, Changing World Order by Ray Dalio. This book is an unbelievably fascinating read. So, and I believe that these are $1 a day. These emerging markets, I don't have them set as high as the developed markets. Yes. So, or the DCA, I don't have that set as high. Cincinnati Tolls, I actually cut it in my one of my other accounts. Sorry. Okay. Yeah, I actually cut it in one of my other accounts. But let's take a look at the fundamentals. Cincinnati Financial. Wow. Good day today. Take a look at the earnings. They've been beating their earnings. EPS has been good. Increasing. Revenue has been increasing. Revenue decreased this quarter and increasing from December. Operating income. I don't like that negative operating income. Had a nice gain. Hi, kitty. Operating expenses, total operating expenses have increased. Don't like that. Let's take a look at the debt. Long-term debt. Wow, they have not paid off any of their long-term debt. For a long time, it looks like. And none. For the whole year. They just didn't pay any of that debt off. It's crazy. I don't like that. Let's take a look at the cash flow. Maybe the cash flow is increasing. Free cash flow. Ooh, decreased. Yeah, I think we're gonna cut it. It didn't meet the, or hasn't met the... Hasn't met the 10%, criteria. They pay a decent dividend. Maybe I will wait. We're gonna wait on this one for another quarter. We'll see what it does next quarter. That one will be on the chopping block, though. Next quarter. Alright, SCHG, this follows NASDAQ. As you can see, hasn't had the best few months here. But neither has the NASDAQ, so that makes sense. We're gonna, this one again, we'll let this one play out. We'll see where it's going. Volume increasing on the selling, don't like that. We'll wait another quarter. We haven't hit the 10%. It's not a lot of money in it. SCHD, I removed this. I don't know why it's still here. Why that dollar was there. But now it's gone, so. Alright, QQQ, we have NASDAQ here. Again, basically did the same thing as SCHD. We're down 2% with 155 in it. Again, and kind of newer one, so I'm just gonna let this one play out. We'll give that one time. Now McDonald's. Down 2%. They paid 2% dividend. I think they're just having a bad couple months. I think they will increase. We'll give this one time. We do have a lot in them. So, this one has been one of the longer holdings in it. I was really happy in February. But, yeah. We'll just let this one play out. This is probably, due to the Middle East war and the cost of oil getting higher. So, we'll let them play by ear. Innovative industrial properties. This is kind of a bet on, which is kind of crazy because here it was leading up to then the announcement of the rescheduling of marijuana. Absolutely tanked it after that. You would kind of expected that would have helped it because it's good for the industry. Because now a lot more tests can be done, and it opens up a lot more of a possibility. It opens a lot more doors for marijuana in the medical industry. So, would have thought that would have been good. But again, this is a daily DCA. Not a lot in it. We gotta let this one play out. So, that one we aren't gonna cut. Google. My old friend Google. That lawsuit isn't doing good for it, but I think Google will be one of them to kind of pull out of that. Like, I have a Google phone. They're so kind of everywhere. They have their tentacles and everything. Google AdSense, like they're a company that makes a shit ton of money. Oh hey. It bounced around. So Baxter, this was one my dad actually sent me. He said he used to do work with them and Ryder, and he said they're a great company. And they keep hitting their 52-week low. As you can see, this is a huge downtrend. Wait some time since. Actually, look, might as well go back to this peak. Since 2020, I think there was some hurricanes. I was reading somewhere there were some hurricanes that hurt their offshore manufacturing companies. And so this is one that I'm kind of banking on a bottom out. This is only $1 a day DCA. So we're just going to accumulate and see where it goes. Let's take a look at the financials though. EPS down, revenue increase in quarter 4, decrease. So the revenue doesn't look the greatest. Long-term debt has decreased a little. They paid off some in that quarter. Let's keep looking. Let's go back to income statement here. So total operating expenses remained roughly the same, as decreased from half of the year. Operating income decreased this quarter, increased last quarter. Increased from December. Let's take a look at the cash flow. Free cash flow is increased increased a lot. I like that. I like that a lot. Significant cash flow increase. That's good. All right, Google now. Let's take a look at Google financials. We kind of skipped over that. Okay, earnings. Just absolute ripping their earnings. 2% increase. EPS out of this world. Financials. I just kind of got in my head there. Sorry. Just thinking. Where am I at? Oh, operating income, minor decrease. I like that the expenses are decreasing too. Balance sheet. Where's the debt? Long-term debt. Wow, they've been paying off a lot of debt. Their debt has been decreasing. That's good. Biggie. 3% down. This is a Vanguard International Depreciation ETF. This is a dividend-focused ETF, but international markets. So obviously the war, which they don't want us to call it a war, it's an operation, and that is going to significantly affect this ETF. VIGI. Let's see. AOL.com. What in the world? I didn't even know they were still around. Defense quality screen for 2026. The fund's strict requirement for 7 consecutive years of dividend growth ensures exposure to high-quality companies with resilient earnings. Analysts suggest this focus on profitability positions the fund well to outperform if U.S. growth continues to cool or stagflation risk rise later in 2026. Ultra low cost structure, maintaining a gross expense ratio of 0.07. The fund remains one of the most efficient, cost-efficient options for international dividend growth. This low hurdle rate minimizes tracking error and enhances long-term total returns compared to more expensive, actively managed international peers. Positive momentum signals. Despite recent drops, technical indicators issued a buy signal from a pivot bottom in late March 2026, coupled with a 3-month MACD buy signal. Some models indicate a high probability of outperforming the broader ETF universe over the upcoming quarter. So let's see what the bears have to say. I think we hit all our music. Here, we'll just do this then. All right. Oops. Bearish. Consistent relative underperformance. The fund continues to lag behind broader international indices like the VXUS, which returned nearly double the fund's gains over certain trailing periods. Its quality screening systematically exclude excludes high growth and cyclical sectors that typically lead during risk-on market environments. Significant recent outflows, investor sentiment has soared recently, with fund recording net outflows of approximately 64 million over the past month and over 340 million year to date. This negative flow data reflects to a pivot away from the fund's specific dividend growth strategy in early 2026. Modest dividend yield with trailing yield of 2.2 to 2.3%. The funds offers less income than traditional high dividend international ETFs. Analysts note it's a total return vehicle rather than an income replacement strategy, making it less attractive for yield-focused investors. Well, and that's the biggie. That one we're just going to see also where it goes. Ooh, look, that they just keep moving around on me. ITA. All right, the aerospace and defense. Now, I put this one in because this one also holds a lot of those drone stocks. Those like RCAT and those other defense stocks, but they're specifically drones. That's why I added this one again. As you can see, very new ad. So we're not even gonna look at that one. We're just gonna let that one sit and brew. Now, Essex Property Trust, down 4%. This is one we'll take a look. We formed a bit of a head and shoulders pattern. Tried to break out. As you can see, it couldn't. So I don't know, maybe we get a bounce off the 200-day moving average on the monthly long term. I don't know. But let's take a look at the fundamentals. Maybe I see something in here. We still haven't hit the 10% mark. The fundamentals are bad. I'm probably gonna potentially cut it. If there's something really egregious in here that I'm like, oh my god, really don't like that, we're selling. Like if cash flow is like significantly decreasing, or I'm just saying an example, but you know, something like that of the sort. Revenue has decreased a little. Operating expenses has decreased. Has been decreasing, I should say. Operating income has decreased this past quarter. Let's look at the balance sheet. Let's take a look at the debt. Long-term debt. Increased there for a little, but they've been paying it off. That's good. And let's take a look at cash flow. So cash flow has been decreasing. Decreased a lot. But they could have used that to pay off some of that debt. So, nothing really eye-opening, like, oh my god. We're still making a little money on the dividend. Kidding. But we haven't hit that 10% mark. So, moving on, Amazon. This one's been in a bit of a pullback as well. A little bit of a correction there. Let's take a look at the fundamentals. I'm a big believer in Amazon. I order stuff from there all the time, especially now with the new house. Oh my god. Like, doing that same day delivery. Fucking nuts. So revenue decreased a little, has been decreasing. There it is. Total operating expenses has been decreasing, so that's good. Operating income has been decreasing. Net income has also been decreasing. Net profit margin, 11%, has been trending up overall. Let's take a look at the balance sheet. The big one on here I care about is the debt. Long-term debt. Long-term debt has decreased from that December quarter, but is now increased from the past 2 quarters. So slight increase there. Now this one, Lithium Americas. This one, fairly new stock. They are a lithium mine, domestic lithium mine. And I just kind of feel like that wouldn't be a bad thing to have in the portfolio. I think the Thacker Pass is a promising project. So let's go to LAC earnings here, because there's really not much to look at on the fundamental or the technical side. Why is that not showing? Horrible EPS decrease. It's like, where's my music? Why are these like empty? Here we go. Operating expenses have decreased. Total operating expense has been decreasing significantly. That's good to see. Operating income has been increasing. Huge. Absolutely huge. So that's good to see. Debt. Long-term debt. They've been paying their debt off. Net income, 5 million. And it looks like they've been doing that a lot of debt paying off, which is good for a small, for a small company, small cap. That's great. Free cash flow has been increasing. You know, they're getting growing out of that negative. Good. This is all good signs. I like that. I really do. So as you can see, it's a new hold. That was one that I was holding in the individual account. I transferred it over. Oh, I didn't transfer it over. I just started a DCA. And then okay, so now we got Michi. Now this is China ETF. Not much to say here. Recent ad, another recent ad. I believe there'll be good long-term, a good emerging market to get into. Now we have Compass. This one's been a little disappointing, but this is gonna be a slow brew too. This is the Compass Pathways. They are in late-stage trials of FDA or for FDA approval of their drug, psilocybin, depression drug, and they are in the latest of the companies that are doing it. They are in the latest stage out of all of them. They are in the late third stage trial. They had very successful in the stage 2. So it's looking promising. Let's take a look at their fundamentals. Oh, there's nothing on there. Earnings, so EPS decrease. Oops. So, operating expense decrease from December, a slight increase from the rest of the 2 quarters in March. Total operating expenses is about the same, is the same. And the operating income is the same. So that's kind of weird. Don't see that much. Net income has been increasing, so that's good. Again, these small cap companies, you gotta take the wins. I do believe in, you know, that's kind of an odd thing for maybe me to say, you know, doing this, these finance streams, but I'm kind of a believer in psilocybin. Where's the debt? Debt. Long-term debt has been increasing. Total equity has been increasing. That's good. Cash flow. Free cash flow hasn't decreasing. I don't like that. But we haven't hit our 10% mark, so we're gonna let this one play out. Now we have CoreWeave. CoreWeave may get replaced with a data center ETF, pending its performance. Looks like we have a little bit of a hammer forming there on the weekly candle. You know, this is a, let's go to the weekly, we'll get a few more candles. But, I mean, downtrend on the weekly. It's a new stock, the hype is over. Partner with NVIDIA. So, this is just one you gotta kind of let the time play out. We'll see where it goes. We haven't hit our 10%. If we hit our 10%, it will get replaced with a data center ETF, because I do believe that that is going to be a growing sector for quite some time. Then we got Rocket Lab. Wow, look at Rocket Lab having a good week. Let's go to the month. So Rocket Lab, this was added fairly recently. Down 7% after some pullback. We started buying it up here. So now, a lot of the time when I add these stocks, I know it's not a good time to buy. But I'm thinking long term, and I can handle some downward, you know, pressure as long as we, you know, are disciplined with our cutting. You know, if we hit that 10% and the thesis is kind of broken, then we cut. So, but as you can see, we haven't hit that. Let's go back. I keep skipping an important part. Let's jump back to CoreWeave quick. Let's take a look at those fundamentals. This is one that we gotta let, you know, burn, or slow burn, you know. Let's take a look. So revenue increases. That's good. EPS has been burdened, but I mean, what just the market trying to figure out what it's worth. So we have revenue decrease. Operating expense. Total operating expenses have been decreasing, so that's good. Operating income, kind of all over the place. A little negative. Kind of, I mean, I don't know what to make of that. We got negative 89, 51, 48, negative 27, kind of all over the place. Net income, again, kind of all over the place. Balance sheet. Let's take a look at the debt. Long-term debt. Long-term debt, they've been paying off their long-term debt, so that's good. Cash flow. Free cash flow. Free cash flow has, again, all over the place. But paying off debt, it's good. Good. You know, that's not necessarily a bad thing for a growing company. Alright, Rocket Lab. We talked about the fundamentals. Or technicals. Sorry. Not the AI overview. So, revenue has been increasing, so that's good, you know. EPS increase, great. Revenue is declining a little bit this year from December. Total operating expenses has been declining. That's good. Operating income down. Net income kind of all over the place. So that's the fundamentals on that. Another slow burn. Gotta let that one cook. Now Red Cat here. We're getting into some of our cutters here. Red Cat, man, this one's been a disappointing one. This thing, as you can see, is prone to major volatility. So this one, again, added very recently. We're gonna let this one cook. We're above. We may get a 10-day moving average crossing the 50, which would be major. So, gotta let this one cook here. This is a new ad. We'll take a look at it next quarter. Let's take a look at the earnings though. Okay. So, so Red Cat Holdings, earnings, kind of all over the place. 7% increase from the previous quarter, which was an 18% increase, which then was down 58%. So, good growing company, get it, I'll understand it. Revenue has been decreasing, increase over, excuse me, actually has been increasing by a significant margin. Sorry. Cost of operating expense. That's the one we're looking for. So, looks like the operating expenses have been increasing. Operating income has been decreasing. Not good. Net income has been decreasing. Let's take a look at the balance sheet. Where's the long-term debt? Well, don't really know. I would guess it stayed the same. Looks like they haven't been paying their debt off. Cash flow, free cash flow. Decreasing. Don't like that. Don't like that, but growing company. We aren't gonna knock them on that yet. We're just on the cusp of that 10%, so we'll let it slide. We'll see where it goes next quarter. Now, Visa. This is one we gotta look at the fundamentals for. It's been in a major downtrend since May. So, really, since last June. And this one kind of surprised me. Would have thought this one would have been performing a little bit better. Let's do Visa. And they don't pay that much of a dividend either, so there's nothing really there for me to hang on to them. It was so we have operating expenses have been increasing. Total operating expenses have been increasing. Operating income has been increasing. So good. Net income has been increasing. Good. Good. Let's take a look at the balance sheet. Short-term investments decreasing. Long-term investments decreasing. Long-term debt increasing. Don't like that. Let's take a look at the cash flow. Free cash flow has been increasing. You know, though, this one just hasn't been performing really as much as I'd like it. It's not necessarily an old one, but I really don't see a reason for me to hang on to this one. So we're selling V. And then we're actually going to stop the DCA on V. And investment. Okay. All right, next one is silver. The Silver's Trust. Now, following gold, typically. Gold has been in a downtrend. This one follows gold. I think we might want to hang on to this for another quarter. Let's see what the bot says. Persistent structural supply deficit. Silver market is entering its 6th consecutive year of structural deficit. Projected shortfall. Another thing with silver too is it's the best conductor of metal, so they use it in chips. In all of our computers, all of our phones, all of our chips. So that's kind of, going to be more of an increase of a demand for silver long term. Here it is. Industrial demand from green energy. Silver remains a critical component in the critical energy transition. Despite some thrifting in the photovoltaic sector, overall industrial demand is supported by electrification, power grid upgrades, and increasing use of silver in automotive, electronics, and hybrid vehicle components throughout 2026. Significant long-term price targets. Despite short-term corrections, major financial institutions maintain an elevated price forecast for 2026. JP Morgan projects silver will average approximately 81 per ounce, while some analysts suggest technical targets as high as $100 to $120 if current supply-demand imbalances persist. Now let's look at the bearish. Hawkish Fed and rising yields, recent war shock, and hotter than expected inflation data have led markets to price out 2026 interest rate cuts, raising treasury yields and a dominant US dollar increase in the carry costs of non-yielding assets, triggering mass institutional liquidations of precious metal positions. Severe technical breakdown, we know that. Industrial sector softness, slowing global industrial activity, and higher silver prices have led to a forecast of 2% decline in industrial fabrication for 2026. Substitution and thrifting in the solar sector combined with potential stagflation fears threaten the industrial demand side of silver's dual purpose value proposition. We're gonna hang on to it. It is below our price point. We don't have a lot in it though, and we're just gonna have to kind of wait and see for that one. Now, Vici, this one has been a major disappointment. Thank you, Vegas, for deciding to charge a lot of money and making it unappealing to go there. It used to be cheap to go there. That's funny. My brother texted me. Sorry. Yeah, Vegas made it very expensive to go there, and now that's what's caused this downtrend. And I think we're gonna cut it. Dividend yield is 6%. That's why I got it. And I just didn't expect. I didn't know about the Vegas thing at the time, and this is a REIT, so it's the properties. A lot of these properties are in Vegas. So yeah, this one I don't even need to look at the earnings. We can just close. Sell Vici, and it's gone. We gotta go here. Vici. Roth. Oh, look, a $6 dividend. I lost 55 though. So end investment. That kind of sucks. That's gonna be gone from there too, because I just ended it. Whatever. We'll have $1.50 to sell. So we did silver. USAR, this is another one, man. It's in a bad downtrend. I think long term this will be a good buy. We just fairly recently added this, so we're gonna let it see where it goes. So we'll let that one slow burn. Let's take a look at the financials though. USAR. This is rare earth metals. So again, computers, tech industry, yada yada. You know, we need that for the computers. What's that mean? EPS has been decreasing. Revenue, we don't know if it has been increasing or not. But we can see operating expenses have been increasing, and the operating income has been decreasing. So we'll go to balance sheet. Oh man, I have terrible posture. Like absolutely terrible posture. We need to work on the posture. Short term doesn't show. Does it show the long term investments or long term debt? No, it doesn't. I hate that when that happens. Cash flow. You can see the cash flow. Free cash flow, wow, has been really depreciating. Depreciating. Decreasing. So, yeah, that's USAR. I mean, long term, I think we are in an uptrend. You know, this was one of those stocks I knew I was buying at a bad time. We were accumulating at a bad time. We don't have a lot in it. We gotta let this one slow burn. Now, APLD, man, this is one. But I mean, when you do that, of course you're gonna pull back. And again, we don't have a lot in it. So I do think we gotta let this one slow burn. I hate to end it on that. But yeah, that's kind of that. We did make some cuts. Now I'm gonna have to go through. Let me pull that up again. Now I'm gonna have to go through and make a note of all these ones that are down. And I'm not gonna do that on stream because that's gonna be really boring. It's gonna be all on an Excel spreadsheet, but I gotta go through and do that. But yeah, that's the stream. Let's take a look at our indices. We'll end on that. Wow, looks like we had a bit of a recovery in the S&P 500, in the Dow Jones, the Rusty Russell, QQQ, the NASDAQ, and the VIX is going down. Wow, that's a bit of a surprise. We're still in the red on the S&P. Oh, no, we're not anymore. Well, no, we are, duh, because we gapped down. If we could turn that into a green day, that'd be huge in the short term. That would be absolutely huge in the short term. So here it is. Yeah, here's the ones we cut. We trimmed up a little bit of Coke. Caterpillar, we trimmed up a little. And then I believe, no, Hershey's was, we sold that. And these were all winners here. And then these were losers. So, yeah, that's it, man. Man, we got a lot of cash. We got a lot of cash. We're holding too much cash. May have to increase some of these daily DCAs in the short term here. But I can do all that off stream and talk about it another time because I gotta think about it. So yeah, very cool, very cool. We did it. We got the job done. Let's take a look. Maybe we'll read some news real quick. Oil prices stay elevated amid geopolitical tensions. Oil prices paired. Oil prices paired some of their early gains after reports that Iran is working with Oman on a potential framework for the Strait of Hormuz helped ease some pressure, although President Trump signaled that the conflict could last for weeks, continued to support prices. U.S. stocks attempt rebound. The three major U.S. I love this website. Trading Economics' website is absolutely phenomenal. For macro, if you are, look at macroeconomics, this site is the bomb. U.S. stocks attempt to rebound. Three major U.S. indices pared early losses to trade around the flat line on Thursday, with the Dow Jones recovering from the initial drop of around 600 points. Both the S&P and 500 have fallen. Experts reach all-time high fueled by gold. U.S. exports climb 42% to a record, or 4.2%, a record 314.8 billion February drop, driven by an 11.5 billion increase in goods exports. Canada posts larger than expected trade deficit rose. Revised. This one, you might want to read that one. U.S. companies cut the 60K in jobs in March. U.S.-based employers announced 60,620 job cuts in March 2026, above the 48,307 in February, but well below the 275 and 240,000 a year earlier. Technology sector. I'm kind of interested in this. Where is it? Something followed by technology sector. Jeez, it's right there. Technology sector recorded by far the highest number of job cuts in March. 18,720, followed by pharmaceuticals, education, and financial. Artificial intelligence led all reasons for the job cuts. Yeah, and I thought they said that AI wasn't going to lead to job layoffs. I thought they said that it was actually going to create jobs. That's what analysts were saying. I kept hearing them earlier. It's like, dude, the jobs that they'll create are going to be 10 to 1. So they're just trying to buy. And I don't really, I just don't understand how you could think that AI isn't going to lead to massive job layoffs. And the funniest thing is, too, is that the people that I hear say that it's not, they'll contradict themselves in the same sentence. I heard this one guy say, what did he say? He said, he said, oh, it's not going to lead to yada yada, it's not going to lead to job layoffs. And then in the next sentence said, it's going to replace the jobs that companies don't want to pay somebody to do. So you just in one sentence said it's not going to lead to layoffs, and then in the next sentence say it's going to lead to layoffs without saying that? Like, are you serious right now? And the jobs it creates will be 10 to 1. Yeah, look at this, man. This is why we don't day trade. This is why we long-term investments, and we routinely check quarterly. But yeah, that's gonna be it, guys. Thanks for shout out to everybody who popped in on the live. It was awesome hanging out with you. Had a blast. We'll do it. We'll see you next July. Let me double check. I believe it's gonna be July 5th. Let me double check for you guys. Calendar. And like I said, I'm gonna try to do a weekly stream, but we will see if I'm gonna be able to make that happen. Where the fuck is it? Yep, okay, my bad. July 1st. July 1st is the next Roth review. I'm going to try to do a stream a week just to kind of cover the current market situation. I'd like to do that. But we'll see where it happens. The buying the house, and there's just a lot to do here, man. It's kind of crazy. It's consumed the majority of my time. And that is an investment on its own. So I bought a fixer-upper, and it's frickin' coming along. Excuse my language. It's coming along great. But yeah, that's it for today, guys. Yeah, man, that's it. Well, here's the send-off for you guys. We're gonna start doing a send-off. Always remember, this is it. This is huge, man. This is, this was, it's kind of cliche, but it really, it helped me. But, when you control your mind, you control your future. Y'all have a good one. Take it easy. It's been good.